In this video, I'm going to walk you through how I construct a tax-aware investment portfolio with $10 million. This isn't something that you can even come remotely close to doing on your own as a DIY investor, and I'm going to walk through step by step how I do it and then quantify just how much better it is than anything else that you could possibly be doing. My name is Samuel, and I'm the founder of Quantitative Financial Strategies, where I work with families with as little as $5 million in investable assets and some families with as much as $100 million in assets. I work with people who are serious about reducing taxes, whether that's for an upcoming business sale, getting out of a concentrated stock position, or just large amounts of ordinary income. All right, so for this example, we're going to assume that $10 million portfolio is split $7 million in taxable accounts and $3 million in retirement accounts. Most portfolios I come across have way too much equity exposure, and specifically US stocks, and even more specifically, large cap US stocks. They've usually got some muni bonds or some taxable bonds, and then they've got some really crappy alts that they were either sold to for a commission, assuming they work with some sort of an advisor or broker, or if you're a DIY investor, you're using some substantially watered down alternative that might not even be worth it. And the tax drag of the portfolio is usually pretty decent between the dividends that the stocks are paying out, any turnover on the stocks where they're actively managing, buying and selling different stocks, income on the bonds. Now, if it's taxable, if it's municipal bonds, technically there isn't a tax drag, but I call it an opportunity cost drag, where the yield is lower on a municipal bond because the income is exempt from taxes. But that being said, the income being paid out is lower than what we can do with what I'm going to show you. And so there's a gap there in opportunity cost. And lastly, the alts that they have are usually horrendously tax inefficient, like something like private credit, where all of it is just being taxed as ordinary income. So let's say the portfolio has an expected return of around 8%, but with a tax drag of around 1 to 2% a year. So what you're really looking at is a 6 or 7% after tax compounded rate of return over time. Now, it doesn't just stop there. There's another problem that people have, like the example we're going to go through, where you have $3 million in retirement accounts. Those are going to be subject to required minimum distributions that start in your 70s, which are going to force you to take that money as income. And that's going to cause, on large retirement account balances like what we're talking about, millions and millions of dollars in taxes as that money is forced out of those accounts. So we're going to want to solve for that problem as well. Okay, so here's a pie chart of the vast majority of portfolios that I see. It's predominantly stocks, it's predominantly US stock. You've got a little bit of bonds, and then you got your crappy alts. Now, the problem with this portfolio is substantially all of the risk is being driven by the equity markets, and we really want to diversify and lower the risk by adding other asset classes that aren't perfectly correlated to the stock market. And so what a hypothetical portfolio for a QFS client might look like is we're going to add all kinds of different asset classes to further diversify you. And so if we look at stocks, we're going to have large, mid, and small cap stocks in this segment here. You're going to have your international stocks, you're going to have your emerging market stocks, but critically, we're going to add these other asset classes like private equity, hedge funds, real estate, infrastructure, and private credit. Now, if we look at this table here, let's just start with the highlighted portion. This is showing you that pie chart that we were just looking at with the allocation percentages and the allocation in dollar amounts on a $10 million portfolio. Now, the first step, assuming this was the appropriate asset allocation for this client, would be figuring out which investments we're going to put in which accounts. If you recall, in this hypothetical, there is $7 million in a taxable account and $3 million in retirement accounts. Some of the least tax efficient investments would be private credit, private equity, and probably infrastructure. Those would be the three asset classes that we're going to prioritize putting in the retirement account. Now, it also happens to be the case that those asset classes are less than perfectly liquid, meaning if I needed to sell them in any given day, I may not be able to. A lot of them have something more like quarterly or annual liquidity. And so they go really nicely in retirement accounts, which we don't plan on touching for decades anyways. When it comes to those taxable accounts, we want to fill those up with asset classes that are not only tax efficient. So instead of having that 1 to 2% tax drag that most portfolios I look at have, we can keep that return, but we can also make them tax beneficial. Meaning on top of the return that they give us these additional tax deductions. which I'll walk through now. So as you can see, infrastructure and private credit, I don't anticipate those passing any sort of tax benefits, nor do I see private equity being able to do that. That's why they work really nicely in the retirement accounts. But if I look at real estate, what real estate is able to do is give you rental income, which you can shield from taxes with depreciation. You're also able to defer any capital gain realization by doing 1031 exchanges. Now, on top of those two benefits, if you have other passive income, you can use the excess depreciation from your real estate investments in your portfolio to offset that passive income that you have coming from even outside of your portfolio. And so a realistic conservative estimate with 100% bonus depreciation back is, in the first year alone, you could probably expect around 25% of your real estate allocation to come back in the form of a passive activity loss. That's just on paper from depreciation. So with this allocation here of 1.5 million, you would expect around $375,000 of a passive income deduction you could take against passive income that you have. Now, when it comes to your stock exposure, what we can do is, instead of just investing in the stock market and capturing that return, what we're able to do is provide meaningful tax loss harvesting, which gives you capital losses that you can use to offset any capital gains that you have, whether that's in your portfolio or outside of it. Inside your portfolio is relatively straightforward, but some examples of capital gains that could occur outside of your portfolio are if you're selling a business or you're selling appreciated real estate that's going to be subject to capital gains or even straight line depreciation recapture. And what's really neat is we're able to harvest over 90% of our stock market allocation in capital losses in just the first year. What I've done for these numbers is I've actually done just 60% of your allocation, and I'll explain that in a second. But your total capital losses in year one with this allocation would be something close to 2.4 million. Now, again, that has nothing to do with economic gain or loss. Think of it more of like a loss on paper, just like depreciation in real estate, which you can use to reduce your tax. Lastly, and this is most people's favorite, is for hedge funds, we're going to do tax-aware hedge funds that not only provide a diversifying return stream that isn't correlated to your traditional stock and bond markets, it's also going to pass this deduction, which is an active deduction. It's going to be an excess business loss, which you can use to take against W-2 income, 1099 income, or even portfolio income. Let's say if you had private credit in your taxable brokerage account, you'd be able to use this to offset that income. And we anticipate around 30% a year in ordinary deductions from our tax-aware hedge fund allocation. That's how we're getting to this $450,000 number. But as someone pointed out on one of my other videos, I try to simplify things for people, but the tax-aware hedge fund police came out and pointed out that yes, these strategies, not only do they realize an ordinary deduction, they also realize a capital gain that is close to the same amount as the ordinary deduction you realize. So if I realize 30% ordinary deduction, I'm going to realize around a 30% capital gain as well. That's really important so that the basis doesn't get depleted very quickly. And that's why I, instead of putting 90% for our stock allocations for capital losses, I put 60, assuming that you're just going to use your capital losses here to offset against the capital gains that are realized on your hedge fund. So the numbers we're looking at are the net tax characteristics. So if you sum them all up, what you're looking at is over 3 million. It's hard to say it with a straight face. This is real. Over $3 million deduction on this $10 million portfolio in just the first year. So I'm going to say that again. These are all sound, diversified investment asset classes that you would have exposure to, but on top of whatever returns they give you, which we'll go through in a second, you also expect this massive tax deduction, which you can use to reduce any capital gains or income that you have. Now, what does that translate to? Well, the capital losses here, you can use those to offset any short or long-term capital gains you have. Most people I work with are in the top tax bracket. So federal, that's going to be 23.8% is your long-term capital gains rate. Then you would add any sort of state taxes that you have. If you're in California, that would be another 13.3%. So you're looking at more like 37% for your long-term capital gains rate. Your passive deduction from real estate can go against your passive income, which was going to be taxed at your ordinary income tax rate. Federal is around 37. Again, again, add your state. You're in somewhere like California, you're looking at potentially 50% or more in your all-in tax rate on this. Same thing with the hedge fund. That's an ordinary deduction. Instead of it being passive, it's classified as active, but same thing in terms of rates. It'd be around 37 to 50%, depending on what bracket you're in and what state you're in. So what I've done here is assumed around a 33% tax rate blended between these, meaning this $3 million plus deduction creates actual tax savings worth around $1 million. Now, what you can do with that $1 million is you can put it back in the portfolio, and now you're compounding even faster and creating even more tax deductions. And when it comes to the return targets, none of this is guaranteed. No one can control what asset classes or markets give us in terms of returns. However, these are the assumptions that we make. For real estate, we do a wide range of strategies that can have expected returns from anywhere from 10 to 14%. Infrastructure is a much lower volatility, stable asset class where we're shooting for 9 to 11%, private credit 8 to 10%. In that private credit, most of the strategies have fund level leverage, so just keep in mind that's how you're getting to the 8 to 10% after fees. Now, when we get to stocks, what I'm doing here is we are actually stacking two different returns. We're stacking the return of the stock market, which most people are going to peg that around 8 to 10% return target, but we also get the additional return from our long short actively managed overlay, which we would expect, if you use the bigger extension sizes, around 4% of annualized outperformance. So that's how I'm getting this number. I'm saying 8 to 10% plus 4% alpha is how I'm getting to the 12 to 14%. Again, just to reiterate, this whole column has nothing to do with taxes. These are just the actual returns that we're expecting or shooting for with these investments. When it comes to the hedge funds, there's a wide range of different strategies you can employ depending on what your risk tolerance is, anywhere between 10 to 14%. And then your private equity, we're shooting for between 12 to 15%, which, you know, if you're doing 12% a year over 10 years, that's a 3x multiple on your money. If you were able to get 15%, that would be a 4x multiple on your money every 10 years. And so what we're doing is in our retirement accounts, we're going to do these guys. And critically, this one right here is the deduction that can go against your active income while you're working, or as soon as you stop working. What we do is we use this deduction to shield the taxes that are created or income recognized on Roth conversions. So recall with this example, we've got $3 million in a retirement account, or retirement accounts plural. We don't want to deal with RMDs, so we will set up a plan to convert the assets in the pre-tax retirement accounts into the Roth IRA. Roth IRAs are not taxed ever again once the assets are in there, and they're not subject to RMDs. So as we use this deduction to get assets in the Roth, we're probably going to prioritize private equity in the Roth because it's the most powerful account you can possibly have. And it's the one that people, when they want to pass money to their kids, we want to prioritize passing the Roth IRA assets, because not only do the heirs inherit those accounts with no tax consequences, they get another 10 years to compound the investments in the Roth without taxes before they then have to take it out. So let's say we're able to get that $3 million into Roth IRAs and you get to compound it. It's mostly private equity. We'll just say you're compounding at 12% a year. Let's say you have 30 years. Well, that's a 9x multiple. So now we're looking at $27 million in a Roth. You pass that to your kids and then they get another 10 years, potentially another 3x multiple on those Roth account balances. So as you can see, everything we're building, not only is it focusing on how to reduce your taxes today in this current tax year, but we're also thinking ahead of how do we reduce your taxes over your lifetime. And the big one is going to be being proactive on avoiding the RMD tax trap and getting stuff converted over to a Roth. And then lastly, we're also prioritizing and thinking about, well, what are we going to put in the Roth? What is the intent of those Roth assets? If it's to pass to your kids, well, then let's prioritize something that has higher expected returns, because the time horizon of this investment account is going to be decades. Okay, so that's everything that we might do in this portfolio. And just to take you back to the ones that I'm seeing, you got your US stocks, you got your bonds, you got your crappy alts. Your expected return on your stocks would be that 8 to 10% because you have no alpha. Your bonds probably 5 to 6%, and then your depends on how crappy the crappy alts are, but I'll be generous and say it's a 8 to 10% expected return. However, if we look at all of this after taxes, you're gonna have a 1 to 2% tax drag. So I wouldn't expect these portfolios to compound anywhere near 8% on an after-tax basis. And as you can see, you have considerably more risk because you're not diversified. So this approach can make sense for you if you have more than $5 million in investable assets. You're in a high tax state or high tax bracket with a lot of income or liquidity events, capital gains coming your way. If you're comfortable with complexity, as long as someone that's experienced is managing it for you, or you're thinking about multi-generational wealth transfer and you want to maximize the amount that you're able to pass on to your heirs, it's probably not a fit for you if you don't have $5 million in investable assets. And part of that is a lot of the strategies we do, you're just not eligible for them if you're not what's called a QP. It's not a fit if you like paying taxes. If you like paying taxes, don't work with me. And lastly, if you want to DIY every move, or you want to hire multiple advisors and then compare them to one another and go with whoever is the best, you are not a good fit for my approach or what I do. So if you watch this and you thought there's no way this can be real, this is too good to be true, then I'd encourage you to use the link in the description and book a call, and I'll walk you through in more details any of the specifics that you want to learn more about. And even if you're not ready for that, please hit the subscribe button so you'll see more videos on sophisticated investment strategies that are going to take your wealth building to the next level. I'll see you guys in the next one.